What's up everybody, it's your boy Jay, and today we're going to do another beginner options video, and it's going to be about in the money, at the money, and out of the money. Those are the three different terms we use to describe our strike prices when we're trading options. So remember, with the last video, what's an option? An option gives you the right to 100 shares of a stock. Whether you're buying the option, that'll give you the right to buy 100 shares. If you're selling the option, then that gives you the right to sell 100 shares per contract. So this is how options traders talk about what strikes they're picking. And it's in the money, at the money, and out of the money. So there's abbreviations: ITM, in the money; ATM, at the money; OTM, out of the money. I rarely trade out of the money contracts unless it's really a gamble, and most likely it'll be with a spread. But for the most part, I'm trading in the money contracts when I'm doing naked calls or puts. Just because there's there's actually profit attached to those contracts, so they're valuable. They have some intrinsic value. And you can make profit if the price or the market price of any stock is above your strike price. So for example, let's say we buy a $100 call and Apple's at 110. Well, that is an in-the-money call because the strike price is lower than the current price of Apple. So let's say Apple's $200. I still have the right to those shares at $100. So that contract is in the money. So any investor who's holding a contract with a strike price below the market price, then they're holding an in-the-money contract, and there's some profit associated with that contract. And they're definitely more expensive to buy than at the monies or out of the money because of that profit that's attached to it. So when you're day trading, I know it's kind of hard. You always want to go with the out of the money because they're so much cheaper and you think you can make a little more money. But that's not always the case. When you're buying in the money, they're more expensive, but they're less risky because they're already in the money. We'll get to this in later videos about, time decay and theta decay. But when you're holding an in-the-money contract, there's less theta decay. And the further you go out, the less time decay you're going to get on your contract. With out of the money, there's a lot of time decay with those contracts. So if you're holding them overnight, you're going to see, even if price is flat overnight and doesn't really move, then you're going to see, you're going to wake up and your contract's going to be down. It's because of the theta decay on out of the money contracts. It's a lot higher than in the money contracts. So your contract loses value over time when it's out of the money. Even the in the monies lose a little bit, but not as much as out of the money contracts or at the monies. So that's in the money. They have intrinsic value because it's in the money and there's profit attached to it. And yeah, they're more expensive, safer to play when trading. Now, out of the money, this is a little more aggressive because you need price to make a significant move in order for you to start making some profit. So there's a lower cost to buy these out of the money contracts because, not like the in the monies, there's no profit attached to it. You're simply waiting for that profit to become attached to those contracts. So there's a lower cost to buy them because there's no intrinsic value. And the potential for 100% loss on out of the money contracts is a lot greater than buying in the money contracts. So the initial cost is pretty low, but like I said before, you're more susceptible to time decay. So when you're holding out of the money contracts and price is having a tough time getting to your strike price, you're going to lose a lot of value on those contracts as price is not able to get to your strike. So you're a lot more susceptible to time decay with out of the money contracts because you need a significant move. You need price to reach your strike. Now, an example of an out of the money contract is if Apple's at $100 and you buy a $200 call. It's going to be a lot damn cheaper to buy the 200 call than it is to buy, the $80 call or the $90 call, which would be in the money. Because let's just say Apple's at $100. we want, we think price is going to go up. So we buy a 200 call. It's probably really cheap, costs you practically nothing. Why? Because it's a gamble. It's more of a gamble than if Apple's at $100, I buy an $80 call. It's less of a gamble because the contract's already got some profit attached to it. I could buy Apple stock at 80 when it's at 100. When you buy a call, an out of the money call on Apple, and your strike price is $100 away, well, you're going to need a significant move for that contract to have some profit attached to it. So if you don't get a big swing in your favor, 100% loss is very, very possible with out of the money contracts. So that's pretty much the difference between the two. Recap: in the money options are options that can be exercised and have value at expiration. So for example, we bought, Apple's at $100. We bought the $80 call and the contract expires, right? It expires. Now we have the right to exercise and buy 100 shares of Apple at $80, even when the price is at 100. So in the money options can be exercised and they have real value. Out of the money options are options that would not be exercised and have no real value at expiration. And then at the money options are just the closest options to the stock's price. So I'll leave it up to you to decide which options you want to trade. If you're going for the gambles, the high risk, high reward, you go with out of the monies. But again, you need a significant move to start making money on those. But it's not impossible. I see there's people that only trade out of the money contracts, and there's people that only trade in the money contracts. So whatever you like the most, but there is significantly more risk attached to out of the money contracts than in the money. But yeah, when I'm day trading, I like going with the in the money contracts. I pay a little more premium, but it's a safer bet, in my opinion. So that's pretty much the difference: in the money, at the money, out of the money. And I hope I made this a little easier to understand for you. But yeah, I have a whole course that teaches you about options and all of this stuff in detail. I'm going to be posting a lot of, free beginner videos on my YouTube, but if you want to dive deeper into options, I put together a beginner course. It's very reasonably priced at the moment. And you'll get access to watch me in the morning, every morning at market open, show you what I'm getting into, show you what I'm looking at. You get to ask me questions every single day on the live streams. But yeah, if you want access to that options course, link is down below, and you're gonna learn everything you need to know about options in there. And I'll continue to post these on my YouTube because it seems like I got some good feedback on the last one, so I'm just gonna keep doing a beginner series on here for you. And yeah, that's the difference between in the money, at the money, and out of the money contracts. If you learned something here today, give me a thumbs up and click that subscribe button if you're new. And I hope you guys enjoy the rest of your evening. Take care.